We expect to see 1 to 3% GDP growth over the next couple of years, combined with a relatively low inflation rate. That's going to mean the Fed's going to be on hold for several years. Rates will only slowly push higher, leading to decent income generation potential and limited but some capital losses. So returns will come primarily through your interest income. The primary benchmark that we look at is the Barclays Capital Aggregate Index. The biggest challenge we're looking at that is it's very heavily weighted towards Treasury securities and agency securities. When you look at within the Treasury component of the index, the duration for the Treasury component is around 5.6 years, with a yield of only 80 basis points. So with a 100 basis point rise in rates, you're going to suffer about 5.6% in capital losses and only earn 80 basis points for that risk. It would take you about 7 years to earn back your capital losses and interest income. And the biggest risk we see in the U.S. bond market is a rising rate environment. Traditionally, everybody's looked to mitigate their credit risk and not mitigate their interest rate risk. We believe going forward that the real focus has to be on that interest rate component and try to mitigate the effects that you have in a portfolio. There has been a big change in liquidity pre-crisis, post-crisis, as the dealers have really gotten a lot smaller over the last several years. So in this environment where most investors are looking to add on credit risk or corporate bonds or non-agency mortgages, it's more and more difficult to buy them because dealers don't have the inventory. Someday that may change, but the purchasing of securities is much more difficult right now. Well, first, I think the low interest rate environment is here to stay for a number of years. I'd expect to see quantitative easing continue through this year and only start to taper off at the beginning of next year, meaning the Fed will probably not even raise rates until 2015, maybe 2016 at the earliest. The Fed is going to be very gradual when they unwind interest rates. They learned their lesson from 1994 when they increased interest rate considerable a lot in a short period of time. So we'd expect them to go gradual and they're going to actually be trailing the market. In this market, you really need to go outside the benchmarks. Historically, everybody's looked for opportunities in investment-grade corporate credit, in agencies and treasuries. The real opportunities this time around are more in the high-yield market, bank loans, non-agency mortgages, both commercial and residential, as well as looking at interest rate-only securities in the agency market, which aren't representative of the benchmark, however, can be a good buffer for a rising rate environment. We really like securities that have a very low correlation to treasury yields. Similar high-yield securities tend to be very lowly correlated. Definitely bank loans with their floating rate component, and most of the non-agency market is a floating rate market, and that should protect you in a rising rate. With the added benefit of a lot of those securities do trade at a discount, and as rates rise, there will be more refinancings, so you're just getting par back a lot quicker as rates rise. I think we are mid to the late part of the cycle, but we have a long period of time to go. You take a look at the amount of deleveraging that's gone through the system, it's been pretty substantial. However, the credit spreads, or OASs, have not tightened in nearly as much as what you've seen in prior cycles. So corporations have not started yet to increase their leverage at all. Maybe not deleveraging as much as they were before, but we had some period of time, we think several years, before they start re-leveraging. Really, the questions have really centered around finding strategies that aren't benchmark centric. Some unique part of the market, like securitized asset dedicated portfolios, bank loan portfolios, maybe some type of short duration high yield portfolios have been a real big focus of a lot of our clients.